Most wealthy men believe they're playing the tax game intelligently when they're actually just bleeding capital at scale. You've been told by your CPA, by influencers, by the entire business culture that spending money to reduce your tax bill is smart strategy. You've been told that write-offs are wealth hacks, that buying equipment and cars and real estate for deductions is how rich people stay rich. You've been told that keeping money is naive and that spending it strategically is sophisticated financial engineering. This is the lie that keeps millionaires trapped in middle-class thinking while believing they've ascended. The truth is simpler and more brutal than most men are willing to admit. Spending $1 to save 30 cents doesn't make you richer. It makes you 70 cents poorer every single time. The math isn't complex, but the psychology around it is so deeply embedded that even men worth 8 figures fall for it. Let's break this down with the clarity it deserves, because this isn't about tax theory. It's about whether you're building an empire or just subsidizing your own financial erosion. When your CPA tells you to spend $100,000 on a vehicle so you can write it off, what actually happens to your wealth? You spend $100,000 of real capital that you earned, that you could invest, that you could deploy. In exchange, assuming you're in the 37% federal bracket, you save $37,000 in taxes. You are now down $63,000 in net worth compared to if you'd simply paid the tax and kept the cash. This is not strategy. This is destruction, dressed up as sophistication. But the cultural programming runs so deep that men celebrate this transaction as if they've beaten the system. They post about their new G-Wagon with the caption, "Tax write-off," as if the government paid for it. The government didn't pay for anything. You paid $63,000 more than you needed to for a depreciating asset. You converted liquid capital into an expense that will cost you maintenance, insurance, and depreciation every year forward. You took optionality and you burned it for status and the illusion of tax efficiency. This is the game that keeps wealthy men poor, not in absolute terms, but relative to where they could be. Let me show you what this looks like in reality, because these aren't theoretical cases. These are patterns I see constantly among men in the $1 to $25 million net worth range. A client worth $4 million, successful business owner, listens to his CPA and spends $200,000 on equipment upgrades he doesn't need yet because the CPA says it's deductible. He saves $74,000 in taxes that year. He's out $126,000 in capital. That capital could have compounded at 10% annually and been worth $327,000 in 10 years. Instead, it's sitting as depreciating equipment that generates no additional revenue and becomes obsolete in 5 years. He traded long-term compounding for short-term tax reduction and called it smart business. Another example, a real estate investor worth $12 million buys a $5 million vacation home in Aspen because his advisor says it qualifies as a business property with rental income potential. He structures it to maximize deductions, takes massive depreciation, feels like he's mastered the code. What actually happened is he tied up $5 million in a liquid real estate. That carries $70,000 per year in property taxes, insurance, and maintenance. The rental income barely covers costs, and he uses the property himself half the year. So the deductions get limited anyway. That $5 million compounding at 8% would have been $10 million in 9 years. Instead, it's a lifestyle asset disguised as a business strategy, and his liquidity is permanently reduced. One more, an entrepreneur worth $8 million decides to lease a private jet fractionally because his CPA says it's fully deductible and makes him look serious to clients. Cost is $400,000 per year, saves him $148,000 in taxes, nets out to $252,000 per year in real cost. Over 5 years, that's $1.26 million in capital burned. Capital that could have compounded to $2.04 million at 10%. He tells himself it's a business asset, but the truth is he liked the status, and his CPA gave him permission to rationalize it. These aren't edge cases. This is the standard playbook that CPAs hand to successful men. Because CPAs are trained in tax code, not wealth strategy. They're trained to minimize tax liability within the current year, not to maximize compounding over decades. They're trained in compliance and deductions, not in liquidity and capital deployment. Most CPAs are not wealthy themselves, and they do not think like wealth builders. They think like tax minimizers. There is a massive difference between those two frameworks, and confusing them will cost you millions over a lifetime. The tax code is designed to incentivize certain behaviors: hiring, investing in equipment, real estate development, business expansion. Those incentives are valuable when they align with your actual wealth-building strategy. But when you reverse engineer your spending to chase deductions, you're letting the tax code control your capital allocation, instead of your vision controlling it. You're spending money you wouldn't otherwise spend just to avoid taxes, which is the definition of letting fear dictate strategy. Fear of taxes is one of the most expensive emotions a wealthy man can carry. It leads to irrational decisions, overconsumption disguised as investment, and the erosion of the one advantage that actually compounds: liquidity. Liquidity is optionality. Liquidity is the ability to deploy capital into asymmetric opportunities when they appear. Liquidity is sovereignty because it means you're not trapped in assets you can't exit or businesses you can't pivot. When you burn liquidity chasing tax deductions, you trade sovereignty for the illusion of efficiency. Let's talk about what actually builds wealth at the level you're operating. Wealthy men do not get rich by spending their way out of taxes. They get rich by keeping as much capital as possible in play, investing it into assets that compound, and letting time do the heavy lifting. Compounding is the highest spiritual and financial law because it's the only force that creates exponential returns without additional effort. A dollar invested at 10% becomes $2.59 in 10 years, $6.73 in 20 years, $17.45 in 30 years. That same dollar spent on a tax deduction becomes $0 in every time frame, because it's gone. The opportunity cost of burning capital is not just the money itself, it's every future dollar that money would have generated. When you spend $100,000 to save $37,000 in taxes, you're not just losing $63,000 today, you're losing the entire compounding trajectory of that capital forever. You're choosing short-term tax relief over long-term wealth expansion, and that is the trade. That keeps men stuck at 2 million, 5 million, 10 million, instead of breaking into the 20, 50, 100 million range. The men who scale past those thresholds understand something foundational. Taxes are a cost of doing business, not an enemy to be defeated at all costs. They pay their taxes cleanly, they keep their capital liquid, and they deploy it into investments that generate returns far exceeding what they'd save through aggressive deductions. They think in decades, not fiscal years, and they optimize for compounding, not compliance. This requires a psychological shift that most men resist because it feels counterintuitive. You've been conditioned to believe that paying taxes is losing and that minimizing taxes is winning. But winning is defined by net worth growth, not tax savings, and sometimes paying more taxes means you're making more money, which is exactly where you want to be. A man who pays $2 million in taxes because he made $8 million is wealthier than a man who pays $500,000 in taxes because he made $1 million and spent another $1 million on deductions. The second man feels smarter because his tax bill is lower, but the first man is building an empire. This is the distinction between scarcity thinking and sovereign thinking. Scarcity thinking says, protect what you have, minimize losses, play defense, avoid taxes at all costs. Sovereign thinking says, expand what you have, maximize compounding, play offense, pay taxes as the cost of winning. Scarcity thinking leads to overconsumption, justified as strategy. Sovereign thinking leads to capital discipline and exponential growth. Scarcity thinking keeps you reactive to the tax code. Sovereign thinking keeps you proactive in wealth creation. If what you're hearing right now is shifting something inside you, if you're realizing you've been playing a game designed to keep you trapped, then you're ready for what comes next. On the Patreon, we go deeper into sovereign wealth strategy, tax optimization that actually builds empires, and the identity shifts required to break past 10 million. This isn't surface-level content. This is the operating system that wealthy men use to compound capital intelligently. If you're done listening to advisors who aren't wealthy themselves, the link is in the description. The wealthiest men I know are not the ones with the most aggressive tax strategies. They're the ones with the most disciplined capital allocation. They buy assets when it makes strategic sense, not when their CPA suggests it for deductions. They invest in businesses that generate returns, not in equipment that generates write-offs. They keep cash reserves that allow them to act on opportunities, not tie up capital in illiquid holdings for tax purposes. They understand that wealth is energy plus intention, and that every dollar spent without strategic purpose is energy wasted. This is not about refusing to take deductions or ignoring tax strategy entirely. It's about refusing to let tax avoidance drive your financial decisions. If you need a truck for your business, buy the truck and take the deduction. If you're buying a truck, you don't need just to get the deduction. You're subsidizing your own poverty. If you're expanding into real estate because it aligns with your wealth vision, use the depreciation benefits intelligently. If you're buying real estate just because your CPA says it's a tax play, you're making an emotional decision disguised as a logical one. The question to ask before any major purchase is simple. Would I make this decision if there were no tax benefit? If the answer is no, don't make the decision. Pay the taxes, keep the capital. This level of clarity separates men who build generational wealth from men who stay comfortable but trapped. The identity shift required here is significant because it means rejecting the advice of professionals you've trusted, rejecting the cultural narrative around write-offs, and rejecting the dopamine hit of buying things under the justification of tax strategy. It means embracing the discomfort of paying taxes as a signal that you're winning, not losing. It means valuing liquidity over assets, compounding over consumption, and sovereignty over status. It means becoming the kind of man who controls his capital instead of letting his capital control him. This is the path of the sovereign strategist, the man who thinks in decades and builds in silence while others perform wealth for social validation. You are not here to impress your CPA or your peers with how little you paid in taxes. You are here to compound capital into an empire that outlasts you and creates freedom for generations. That requires different thinking than what got you to your first million or even your first 10 million. It requires the humility to admit that much of what you've been taught is designed to keep you compliant, not wealthy. It requires the courage to stand apart from the consensus and operate from first principles instead of inherited frameworks. And if you want to go deeper, you already know where to go: the Patreon. Welcome to Luxona, where men refuse to play small.